Hello and welcome to Viking Venture's first ever webinar. Today's topic is top SaaS KPIs and how they affect valuations. We have 30 minutes for the webinar today, which means we'll have a presentation that lasts for around 25 minutes, and then we'll have 5 minutes at the end for any Q&A. So if you have any questions, make sure to write them in the Q&A function, and we will do our best to answer them at the end of the session. Before we jump in, I thought I would quickly introduce myself and Viking Venture. My name is Martin Eriksen, and I work as an investment manager. Viking Venture are the leading Nordic B2B software investor. We invest in Nordic software companies, and we help them scale. That is all we do. And this singular focus means that we have a lot of experience and expertise, which we utilize when working actively with our portfolio companies. Now, if you look at the right of this slide, you can see all of our active investments. This is a mix of 16 portfolio companies, which is a mix of both public and listed Norwegian, Swedish, Danish, and Finnish companies. These companies have ARR between 4 million euros and 90 million euros, so a good mix of different companies, and none of them are competing, which means that they all feel very comfortable sharing best practices and experiences with each other through our Viking Venture community, which both we as an investor and the portfolio companies find really valuable. If we look to the left of this slide, we can see our investment criteria. And as you probably understand now, we invest in B2B software companies with a headquarter in one of the Nordic countries. We look for companies that have revenues or recurring revenues of 3 million euros or more. And they don't necessarily need to be growing at high rates when we invest, but we need to see that there's a great potential for growth going forward. Now, the fourth point here is probably the most important criteria that we have when investing in new companies, and that is that it needs to be a software that supports work processes. We like companies that have software which is considered to be need to have and not nice to have by their customers. In other words, we invest in business critical software. Now, Viking Venture, we are an active minority investor. That doesn't necessarily mean, however, that we don't do majority deals. We're quite pragmatic in the way we work. We have no problem doing both primaries and secondaries, meaning we can buy shares from existing shareholders or invest capital directly into the company to fuel further growth. And as any good investor will tell you, we are founder friendly. But this is something that we definitely really take to heart and something that we try to prove in the way that we typically work with our portfolio. And an example of this is we invest in the same types of shares, so only one share class, and we typically try to stay away from any preference structures. And what this means is that when we invest and we become an owner, we sit on the same side of the table as everyone else so we can really work together. Perfect. So now that we have introduced Viking Venture, we can move on to today's topic. And today's presentation is split up into 3 parts. The first part being a bit of a description in terms of how to track annual recurring revenue. The second bit being a SaaS KPI deep dive. And then we'll end the session with a description of how we value companies through our Viking Venture valuation scorecard. And then again, just to remind you, if you have any questions throughout the presentation, make sure to write them in the Q&A function and we will answer them at the end of the session. So tracking ARR. This will probably be pretty basic for a lot of you, but the truth is that we still experience when speaking to new companies that we want to invest in that a lot of them don't track ARR in an efficient way, which easily allows them to create what we call the ARR bridge, or which is sometimes called an ARR waterfall. And when we say ARR, what we're typically talking about is contracted ARR. And this means that once a contract is signed, we include the numbers in our ARR. And the reason that we do this is because ARR for us is a forward-looking measure. We want to know where we're going to be in the next 12 months. And this means that if you have a big gap between contracts signed and the actual delivery of your software, this is something that you need to track as well so that you know that you're in control. Now, the reason that we love the ARR bridge so much is because it gives us an easy way to track the development of ARR throughout a certain time period. We can easily profile a company by seeing the growth split up into the different categories. Now, the categories that we're looking at here are new sales, which is obviously sales to new customers. Upsales is sale of new functionality to existing customers. Expansion is more users and higher usage. Price adjustments are price increases or price decreases. Contraction is fewer users or less usage. And churn is the termination of a contract. Now, we also include inorganic growth here, which, like we have in this example, could be, for example, M&A, but that could also be things like foreign exchange if that's relevant to your business. So what we easily see through this is we see how does ARR come into our business and how does ARR go out of our business. Does our company grow primarily through new customers, existing customers, or have we been able to find a good balance between the two? The bridge also gives us the basis to calculate a number of KPIs, some of which we will dig a little bit deeper into now. So we've created what we call the Viking Venture KPI dashboard, and this is something that we use to analyze the performance of our portfolio companies every single month. Each month, the portfolio reports a number of KPIs and a selection of finances, which are then uploaded to a Power BI dashboard, which allows us to track the performance on a continuous basis. And this is a mix of KPIs split into three main categories. And those categories are growth and profitability, customer acquisition cost and sales efficiency, and coverage model and sales process. Now, what we also do is twice a year, we do a deep dive into our portfolio companies. And this KPI dashboard plays a pretty important part in that. We look at every single KPI and then we grade them on a scale from underperforming, performing well, or overperforming. And what this does is it gives us a helicopter view of the company and allows us to quickly and easily see where we need to focus in the next 6 to 12 months. Now, the KPIs that we can see highlighted here are the ones that we're going to focus on today. And these are also some of the main KPIs that we include in the valuation scorecard, which is the next section of the presentation. Now, the reason we've chosen these is because they're usually readily available, they're usually standardized, and they tell us what we need to know about size, growth, profitability, and risk. We always start with the ARR bridge, and the first KPI that we're going to look at is total ARR. Very easy to calculate. We simply take the contracted MRR, or monthly recurring revenue, and multiply this by 12 at the end of whatever period we're looking at. And the reason that this is important is because whether we like it or not, size matters. The bigger the company, the less risk connected to it. This also provides us with a lot of context when evaluating companies and evaluating KPIs. So for example, growing by 30% organically is much easier if you have an ARR of 3 million euros than it is if you have an ARR of 10 million euros. So that's really important to consider when looking at KPIs, and especially looking at the KPIs that we're going to be talking about today. Now, once you reach a level of 3 million euros or more, then you've typically proved that you have a product that the market wants, and you've found a way to sell that product. So you have what we would call product market fit, but you also have what we call sales market fit. And for us as an investor, this typically means that you're ready to scale. Now, organic growth is by far the biggest driver to valuations in B2B SaaS. Yes, markets have changed and profitability has become more important, but we still see the largest correlation between high valuations and high growth. Again, easy to calculate when we have the ARR bridge. We simply take any inorganic growth that we have and exclude it from the growth calculation. Now, organic growth can come in many different forms, and it's important to demonstrate that you can grow and succeed in all of these, be that selling to new customers, selling more functionality or increasing usage to existing customers, increasing prices, and at the same time keeping churn and contraction low. The businesses that typically receive the highest valuations are the ones that are successful in growing organically, both through existing and new customers. So make sure to keep that in mind when working on developing your companies. Now, when we look to invest, we typically look for companies that have the potential to continuously grow organically at 30% or more if organic sales is our main strategy. I mentioned profitability on the previous slide, and it's something I'm going to mention a lot in this presentation. And there's no doubt that this has become really, really important recently. Markets are uncertain, and when this is the case, profitability and control of cash becomes paramount, which is obviously something that's reflected in both investor sentiment, but also in valuations. Now, EBITDA is used quite often because it's a standardized metric across geographies. However, as we know, software companies can often capitalize quite a bit of R&D cost, and this is excluded from EBITDA. And that's why it's important for us to also look at EBITDA margin, which is EBITDA minus capitalized R&D cost. This is a quick proxy for cash EBITDA, which will get us a little bit closer to understand the cash situation in a certain business. Now, 2022 was a year where a lot of SaaS companies decided that they needed to improve profitability, and then they decided to cut costs. And the reason that EBITDA is so important is because it takes time for your cost-cutting measures to be reflected in your numbers. If, for example, you decide to decrease your headcount, it can take anywhere from 3 to 6 months before you actually see the benefits of this. And that's why it's so important to always model your business 12 months forward so you're able to make these decisions in good time. Now, this leads us nicely to the next KPI, which is the famous Rule of 40. Now, this is a combination of growth and profitability, where we want to demonstrate a good balance between the two so that we have what we would call efficient growth. Now, there are many different ways to calculate this KPI, but we've landed on the version in the middle here, highlighted in bold, where we take the ARR organic growth rate and add that to our EBITDA margin. If the sum of these two equals 40% or more, then we can be considered to be a good and healthy company with efficient growth. Now, this KPI has risen to popularity due to the increased focus on profitability, but it's important to note that not all Rule of 40s are created equal. A company that has 30% organic growth and 10% EBITDA margin will be valued higher than a company with 30% EBITDA margin and 10% growth, even though they both satisfy the Rule of 40. And the reason for this is that growth is still more valuable than profitability. So if you need to choose between the two, make sure that you choose growth. Now, another important point to make here is to also consider what stage your business is in. If you've just raised a lot of capital and you're investing by ramping up your new sales, for example, then it can take quite some time before these investments actually show themselves as growth. And that means that you're basically sacrificing your Rule of 40 for a certain period of time, which means that it may not be that relevant a metric for you to track yourself on. However, you need to make sure that you're on the path to satisfying the Rule of 40. And if this is a KPI that you're interested in, which a lot of people are, and there's been written tons of articles on it, which we have also done. So if you want to learn more about it, we have a KPI, a Rule of 40 article on our website. So make sure to check that out. So SaaS companies are inherently profitable. And the reason for that is because they have scalable software, which is delivered to customers through the cloud. This means that there's very limited costs related to the delivery of the product. So in many cases, customers simply log on to the product through a browser. So that means SaaS companies have high gross margins. And if you look at the P&L of most software companies, their margins can be as high as 95%. But this is pretty misleading because a lot of software companies will simply include hosting costs to their cost of goods sold. The shift in the market has caused increased focus on profitability, but it's also meant that investors are spending more time now looking into gross profit margins. What we're seeing is that not all SaaS companies are as profitable as we once thought. Software as a service has developed greatly, and there's now many different delivery models and many different constellations of ARR. So to gain control of this, we need to look at our SaaS gross margin, which includes all the direct costs attributed to the delivery of our product. We need to include support costs. If our customer success works on keeping the customer happy, we need to include a portion of their time. If we have any maintenance costs in the form of bug fixes, then we need to include this as well. And if we use any third-party software in the delivery of our own software, these costs need to be included as well. Basically, we need to know how much does it cost to deliver our software in its current state to our existing customers. And what we typically look for here is at a SaaS gross margin of 75% or more. Okay, net revenue retention, or NRR. This looks at measuring how much we grow with our existing customers. And to calculate this, we compare our organic growth over 2 time periods, simply excluding new sales. Basically, if we didn't get a single new customer over a time period, would our ARR increase or would it decrease? If your net revenue retention is above 100%, it means you're able to increase your share of wallet with your existing customers over time. If your net revenue retention is below 100%, it means that your existing customer base will decrease over time. Now, this KPI has also risen to popularity like many others recently, and that's because of the way that the market is today. A lot of companies are experiencing slower new sales growth rates, which means that it's more relevant to focus on existing customers. It's much easier to sell to an existing customer than it is to sell to a new customer. And this is a great KPI to track because it includes so many different facets of ARR growth. It includes upsells, expansion, price increases, contraction, and churn, meaning it'll make it pretty clear if you have an issue connected to any of these. And companies that typically have low net revenue retentions usually struggle with churn, but they can also be that they haven't had a sufficient amount of focus on upselling their current customer base, or that they're not consistently working with pricing of their products. And in terms of benchmarks, what we would typically look for here is a net revenue retention of 110% or more. This is the last KPI that we're going to look at, and it's the customer and industry concentration. And this is calculated by taking the ARR of your largest customer and your 10 largest customers and dividing this by your total ARR. And for industry, you do exactly the same. You take the ARR from your biggest industry and divide that by your total ARR. And this tells us something about the inherent risk connected to a business. We like companies that have low customer concentration and low industry concentration, because there's a lot less risk connected to those customers. Now, when it comes to customers, it means that no customer has an unproportional amount of power over us, and that a single customer churn won't have that much of effect on us. When it comes to industry, it means that we're not affected by any industry cyclicality. An easy example here is to look at the oil and gas industry. If we have software that is only sold to oil and gas, and the oil and gas price goes down, these companies will have more focus on their costs and less budget to spend on our software, which will have an effect that our growth rates will go down. This is all about ensuring that customer and industry risk is as low as possible, but it's important here to split this between different types of software. If you sell enterprise software, these numbers will be completely different than if you sell SMB software. So make sure to keep that in mind. A few concluding thoughts on KPIs before we talk a little bit about valuations. So the more KPIs, the better. That's not an idea that we typically subscribe to. We believe in choosing a North Star and a handful of other KPIs to focus on that are really core to your business so that you know where you're going. You also want to ensure that you're tracking your KPIs over time so that you can see the development and any trends that are appearing. Make sure that you segment your KPIs to gain further insight. So yes, your churn may only be 7%, but are there any big changes or differences in certain customer groups or certain geographies that you need to be aware of? And when it comes to KPIs linked to sales especially, break it down into fully ramped and blended representatives. And by fully ramped, what I mean is someone who has been through onboarding and who we consider to be 100% operative. And by blended, I mean a mix of both fully onboarded and completely new sales reps. And the reason that this is important is because knowing what our fully ramped sales reps are capable of will provide us with a benchmark to which we can then measure our new hires on. And lastly, when you've done all this work, you've tracked all these KPIs over time, you see the trends, make sure to utilize that insight and knowledge when running your business. Include it in any business models or forecasting that you have, and make sure to spread it across the organization so that everyone knows what they mean, everyone knows what your KPIs currently are and what your goal is. Now, we've talked a lot about KPIs and ARR, which leads us nicely to the next section, which is valuation, and more specifically, the Viking Venture valuation scorecard. Now, we base our valuation on two main inputs, which is market sentiment and company-specific KPIs. And by combining these two, we can quickly calculate an EV, which is enterprise value, which is the value of your company, divided by ARR multiple for whatever company we're looking at. Market sentiment is outside of our control. We can't do anything about it, but it definitely will impact our valuations. So we need to make sure we include it in our methodology. Now, many of you probably already subscribe to our Viking Venture Nordic SaaS Index, but for those of you who don't, this is a great way for us to track the value development of listed Nordic stocks against the BVP Cloud Index, which is what we use in our valuation model. And as you can see from this graph, valuations have taken a hit in the last year or so, and the median last 12 months enterprise value to sales multiple for the BVP Cloud Index currently sits at 6.4. And for a bit of context, when SaaS was at the height of its popularity in recent times, the median LTM EV sales multiple for the BVP Cloud Index was at 18x, so a pretty big fall. So to include this market sentiment in our valuation, we use the median multiple as our starting point. So like I mentioned, we can't do anything about the market. It is what it is, but what we can do something about is our own business and our own KPIs. We created the valuation scorecard around 4 years ago to value companies that we were interested in investing in. But we also use it to value our own portfolio and to value any M&A targets that our portfolio companies are looking to acquire. The goal was to create a simple model which would give us an accurate valuation of a company using a few easily available KPIs. So if we look at this example, company X, this is a company with 91% of its revenue of a recurring nature. It has an ARR of 16 million euros, 23% organic growth, a European presence, 80% gross margin, net revenue retention of 109%, LTM revenues of 15 million euros, and an EBITDA margin of 13%. A good company with good KPIs. But how good and what valuation does the model give them? To work this out, we compare each KPI to a benchmark. If the company scores higher than the benchmark, they receive an addition to their multiple. If they score below the benchmark, they receive a discount to their multiple. And when we sum all of this up, we end up with a final EV ARR multiple. Pretty simple, and the logic and methodology behind the model is, but what the complicated bit is figuring out how much weight each KPI should get and how big the discounts and additions should be. This model is continuously being updated to make sure that we're always refining it and to make sure that we're always including any big shifts in the market. So an example of this is a previous version of the model simply included the rule of 40 as a KPI. But what we have seen is that there's a big difference in terms of how much growth is worth versus profitability. So to fix this issue, we split it up into its two parts where we both grade the organic growth and the profitability separately, which enables us to add or attribute more growth to the profitability bit. More growth to the growth bit versus the profitability. Now, this methodology and this way of valuing companies is quite mathematical. And valuing companies in this way allows us to quickly see where a company is strong and where a company is weak. And this is something that we use all the time internally at Viking to look at where are our portfolio companies weak? Where do we get the most bang for our buck in terms of valuations? So where do we need to focus on to increase both valuations, but also the development of our companies going forward? So to conclude, a super relevant tool that we use all the time. So that concludes the presentation part of this webinar, which I hope you have all found really insightful, and hopefully some of you even learned something. A few closing remarks here. We are working on putting together a new KPI benchmark report for our portfolio for 2022. So make sure to check that out when it's ready. And if you would like to subscribe to the Viking Venture Nordic SaaS Index, then you can find a subscription link on our website. So then I think we have a few more minutes to do a few questions. And the first question that we have on screen here is, what KPIs would you say impact valuations the most? I think we mentioned this, and I think it's important to always keep up to date on the way that the market's moving. And we went from a growth at all costs mentality where it was all about organic growth and as high organic growth as possible, where we sacrifice everything else. But what we're seeing now is that profitability is becoming more and more important. But I think the conclusion here is that organic growth is still the #1 driver to valuations. And that's the way it's been for a long time. And I think that's the way it's going to be going forward as well. Next question is, how do you choose the North Star to focus on? I think this is a really good question, and it would be easy to say, okay, organic growth gives the most effect on valuation, so we're going to choose that. And I think that is true in some cases, but I think you really need to consider what type of a strategy does your company have? Are you an organic growth strategy? Do you have an organic growth strategy, but mainly towards existing customers, a so-called land and expand strategy? Or do you have a buy and build strategy where you're not able to build this organic growth engine, but what you can do is you can acquire a lot of companies and build them into a bigger thing. So I think what you really need to consider is what's our main strategy, what are the KPIs linked to that, and choose that as your North Star, and then choose the underlying KPIs as well to support that. So if you have a land and expand strategy where your new sales growth is maybe not that high, but you're really able to fill it in with existing customers. So your North Star would be your net revenue retention. And then you really focus on your organic growth, your churn, and your rule of 40 to make sure you're also keeping the eye on your profitability. Do you look at CAC for existing customers, i.e. how much does it cost to increase the ARR of an existing customer? And I think this is something that we definitely spend a lot of time on, and we haven't spoken that much about sales efficiency KPIs in this presentation. But customer acquisition costs and how much money are we spending on gaining a new customer, both completely new customers, but also how much are we spending on actually building our customer base and increasing our net revenue retention is something that's definitely relevant to look at. And once you become a little bit more experienced in KPIs, you can move into these types of KPIs. So I think it makes sense for us to maybe attribute our next webinar to looking at sales efficiency KPIs, where we can expand a little bit more on those customer acquisition costs and other sales efficiency KPIs. Perfect. One more question. How do you get control of all these KPIs? Any tools you recommend? This is also a really good question, and one that I'm afraid I'm not going to be able to give the best answer to, because we've spent a lot of time looking into different software solutions that are able to sort of track ARR and subscriptions and sort of produce a number of KPIs that are relevant to us. And the truth is, we haven't really been able to find that perfect solution. And like I'm sure a lot of you have done, we've sort of resorted to using Power BI. So when we create the Viking Venture KPI dashboard, that is a Power BI dashboard that we have created together. So there's an Excel import, and then that all gets calculated into the Viking Venture KPI dashboard. So for us, Excel and Power BI is the way to go. But I know that a lot of other portfolio companies are always testing new solutions. So I think that's definitely something that we're going to be looking into. Perfect. I think that's all the time we have left. So we just want to thank everyone for tuning into the webinar, and we'll make both the slides and the recording of the webinar available to everyone. And if you have any more questions, then you can shoot us an email and we'll try to answer them as good as we can. So thank you so much to everyone who joined the session today.